Intel is down around 61% year to date, now trading at its 52-week low. So is this the best semiconductor AI stock to consider in the portfolio for massive growth over the next few years? Has the market overreacted? We're going to find out in today's episode, getting to our own valuation. And just as a reminder, we want to take a look at how their earnings was. Now, for those that don't know, they are expecting to cut around 15% of their workforce. We can see that would equate to around 15,000 employees. And as we are about to show you, they had worse than expected quarterly results. And on top of that, they've issued light guidance, which the market, as we saw, did not like at all. This company has been down significantly, one of the worst performers, in fact, in the S&P. Now, in terms of what those numbers were, well, they had 2 cents adjusted in terms of what they reported. 10 cents is what the market expected, so quite a big miss. And we also note a miss on that revenue, 12.83, as we can see, 12.94 billion expected. Now, there is some good news that has come out just over the last few days. We have seen they have agreed a 3.5 billion deal to make chips for the military, and this will be a very good sign for shareholders who at the moment haven't faced the best 2024, although over the longer term, as we will come to see, Intel hasn't performed that strongly. And as we can see here, they have qualified for as much as 3.5 billion in terms of federal grants to make semiconductors for the Pentagon. So that is a positive news for the company, something that has really lacked lately. But we also find out in other articles just this month that Intel is being talked about one of the strongest companies to buy in the S&P 500. Granted, it is one of the worst performers, so again, you could argue perhaps the market has overreacted. But do also remember, not only is September the worst performing month in the S&P historically, but the last 2 months of an election, so September and October, have also not just been the most volatile, but in fact, over the last 6 presidential cycle elections, they have been down around 4.2%. Now, that is just a piece of information that we do want to deliver today, but we also want to note, as we can in fact see here, that this is a company that a lot of analysts are starting to look at now. We can see it is held by around 75 hedge fund holders, and in fact, it is one of the world's leading semiconductor chip companies by revenue. And some of the reasons why this company is still looking very strong, as we can see, they play a massive role in these chips that are used for personal computers, as well as powering augmented reality devices. So there is a lot to consider with this company. We're not just going to talk about all of the negatives. There are also some positives, but we also want to, just before we look at any further information, really highlight how their latest quarter was. As we mentioned, 12.8 billion of revenue. Now, when you compare that on a year-on-year basis from the same quarter, that was down around 1%. When we look at the margin, as always on this channel, we do want to see an increase to revenue, an increase to margin. Unfortunately, it was down around 1.1 percentage point on a year-on-year basis. In fact, from what they expected, it was down 4.8 percentage points. And unfortunately, the earnings per share not only down around 11 cents on a year-on-year basis, but again 8 cents from what they were predicting in April. So not looking great at all for management in terms of the numbers, but again, things can change very quickly in the market, and we just want to show you this to highlight the company. They have had decreasing revenues over the last few quarters, as well as the margin. Again, if you want to compare it to quarter 2 of 2023, we can in fact note 12.9, now sitting at 12.8, margin 39.8, now sitting at 38.7, and in fact, in quarter 2 last year, they did have 0.5, as we can see, billion of operating income. That sits at nil for this latest quarter. So lots to work on, and what we can see for the next quarter, they are anticipating this to be down 1.2 billion from a year-on-year perspective. That is double digits. So not looking great at all. And we can also see gross margin down another 7.8 percentage points, with in fact their earnings per share. And again, this is just to highlight, so when you do see the earnings, so there are no surprises, they're anticipating negative EPS, which is down double digits quite significantly, 44 cents on a year-on-year perspective. Now let's actually get to looking at this company in terms of how they've performed and the numbers moving forwards. As we mentioned, year to date down 61%. Over the last 10 years, again, not the greatest, negative 44%. And we can in fact see right now it is trading at one of the lowest, if not in fact the actual lowest it has traded over the last 10 years. And we will take a look at their earnings per share shortly. And we can clearly see here all three analysts do give this a hold rating. Now, we also want to run through the typical metrics we look on this channel. As we can see, they used to be a dividend paying company. In fact, it wasn't too long ago where they did have a 49% cut. As we've seen from the latest quarter, they in fact did halt that dividend, so it won't be paid. We have over the last 5 years, negative 9%, no surprises given both the cut and the reduction last year. Over the last 20 years though, however, we do know they had increased that dividend at a double-digit rate. Now, in terms of the free cash flow payout, very irrelevant given the fact they no longer do pay a dividend. But if you do want to see it here, historically it was around the 40 to 60% level, which is what we like to see. Although we will now show you over the last few years and on a trailing 12-month basis, the reason why this is negative is because they had negative free cash flow. And on this channel, as we always like to say, we want increasing free cash flows over the longer term. Unfortunately, we can clearly see they were unable to hit this over the last 2 years, and over the next 12 months that is expected to continue. Again, just certain things that we do want to highlight for those that are interested in this company. Sales growth 3 to 7%. Unfortunately, the last 2 years have been very poor on this company. Double-digit negative decreases, although on a trailing 12-month we can see positive too. So ultimately what this means, something very interesting to note, in 2014 they reported a larger revenue, their top line, than we just saw in 2023, although we do see it had incrementally increased up until 2021, and here we can see the fall over the last 2 years, double digits. In terms of shares outstanding, we notice both share buybacks, which we like, as well as share issuances, so diluting your position. But over the longer term, we do notice the net effect here being a share buyback. In 2021, we see the reversal of that going to share issuances, something to consider as we do believe they will continue to do that in the current market. Now, in terms of the ROIC, as always, we want 10% or more. We do get that pretty much from 2014 to 2021. Unfortunately, the last 2 years, it has suffered significantly. And why we like this metric, it does ultimately give us faith that management can effectively allocate their capital. Now, in terms of margins, as always, operating efficiency, we do want to see this increase at a minimum around 12%, which we can clearly see again for the 8 of the last 10 years. The more recent 2, though, very poor, and what this ultimately means, if they are having a 0% on their operating margin, they will have ultimately made a loss in that more recent year. And again, free cash flow margin looking very healthy for the last 8 of the 10 years. Last 2, though, not looking good at all. And you could argue this is something we do need to factor in when we look at our investor margin of safety. Now, net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Ideally for this industry, so semiconductors, we want below 1.5. And what these numbers are, the number of years it would take the company to pay off all of their debt net of cash on hand. 2 in 2023, so no surprises why they did cut that dividend. And in fact, it has been increasing from 2020. Again, positive, we can note it is expected to come down a little bit over the next 12 months, but a little bit too high for what we want to see. As we have mentioned in previous episodes, they are looking at doing a cost reduction. In fact, we just saw today 15,000 employees, so that should hopefully help some of the numbers that we do see for Intel and moving forwards. Now, before we continue, just to let you know, we have released our latest weekly article. The next one is dropping tomorrow, so do click on that pinned comment below to sign up, where you will get that delivered straight to your inbox. We have also released 25 undervalued stocks for your consideration for the month of September, so if you do click below, you can grab a copy and read, and we also run through each one that sits within our own portfolio, as well as a spreadsheet which talks about the 22 stocks that have the most upside right now in the S&P 500, something to go through and see whether or not any of these do fit in your own portfolio. What we also like to do on this channel is look at insider and institutional ownership and their movements. So insiders 0.04%, no selling over the last year, which is quite interesting for a company that has suffered massively. We get one insider buy over the last year, and in fact that is for around $1 million. What we do note, the more recent in Q3, around $252,000. And when we do find out who this is, it is in fact the CEO who did add on the 5th of August. We can see 12,500 shares around $20, so not far off the current trading price, and as we mentioned, the amount there. Now, we do like to see this on the channel. Insider buying, as we always say, very bullish. Insiders buy because they believe the share price will go up. Just bear in mind that he has bought shares quite consistently. In fact, he was buying at the beginning of this year around $43, then continued to buy around $31 and $30. So again, just take this with a pinch of salt. And as we always say, never copy what insiders do, as well as the institutions that we are going to look at now. So institutional ownership sits at just above 64%, around $7 billion worth of sales over the last 12 months, pretty much double over the same time period, which is good. It shows institutions do clearly like this company, and we can in fact see over the last 4 quarters, and in fact the more recent quarter, more importantly, institutions have been buying more, in fact double as we can see than the amount they have been selling. So very interesting to note all of this, but as always, make sure you have your own investment thesis before you execute on any company. Now, we have talked about the revenue, but it is important to understand the bottom line as well. Income in terms of revenues has been very inconsistent over the last 10 years, in fact decreasing from 2020 and 2021. But what we ultimately want to understand here is how has that bottom line net income progressed? And what we can see, it's gone from around 11.7 billion in 2014 down to around 1.7 billion. So actually decreasing. That is not a trend you want to see in any company you invest in. 2018 down pretty much every single year, very low in 2023. On the trailing 12-month basis, that does give us a sign that ultimately it will even be lower than the previous year, so that downward trend could continue. Again, these are just different elements for you as an investor or as a shareholder to consider in your allocation. Now, a quick health check, total cash versus total debt. We notice a trend which is pretty much inconsistent on a year-on-year basis. Nonetheless, it has increased from 14 billion to around 30 billion in that latest quarterly report. How does that compare to their total debt? Because that is ultimately what we want to understand. Otherwise, in isolation, we don't get much data. Well, unfortunately, total debt has been increasing over the longer term, going from around 14 billion in 2014 to around 53 in that latest report, which therefore we can understand why they have been doing these reduction cost analysis. Therefore, we do understand why they are looking to reduce their costs, whether that's through cutting their workforce, cutting the dividend, and other measures that they are looking to seek. So not a great sign from an investor perspective, but as well, if you're an employee of the company, not something you want to see either. But as always, we are just highlighting these issues so you can take a look. Then we get to how they performed against analyst targets. Now look, over the last 4 quarters, 3 of them they have beaten, so a 75% track record. Just unfortunately, the more recent quarter was a miss, so not great at all, and we can see the expectations for the next few quarters. Ultimately, if they do hit the earnings per share estimate for 2025 at 1.2, the forward P will come to around 16.44. Again, it will depend based especially on how they've reported just in that more recent quarter. If you have the faith, they can hit those targets, and remember, they have issued lighter guidance as well. Then we're going to look at some very quick ratings and underlying metrics. First one, a D on the valuation. When we do take a look at the P on a non-GAAP, not something that we can really consider in today's episode, given that this number has been inflated, but as we saw, it will be sitting around 16, 17, and that is ultimately below the sector median. So if we were to look at this, and in fact you can pretty much see on any other valuation method, this does have a fairly decent grading. So we do believe right now for Intel you are getting a discount, but as always, sometimes it could be warranted. The quality of the company may not be as strong, and that is why you get that discount that you can see for this semiconductor. Again, just things to consider. Just because it is a discount doesn't mean it should be a straightforward buy. In terms of grade, well, they get an F, as we can see, year on year around 2%. Sector median around 3, so marginally higher. In terms of forward looking, well, negative growth anticipated. For the sector, a lot better. Ultimately, it is positive, and it is mid to high single digit at 6.6. But one thing we like to bring to your attention, a bit of good news here. Earnings per share anticipating 40% over the next 3 to 5 years on average. We can clearly see the sector median a lot lower at 14.6. Then we'll bring you on to the profitability grades where they get an A+. We do note their margin is lower than the sector, 41 versus 50. We can also see their bottom line lower, 1.77 versus sector median of 3.63. But the saving point for this company is in fact their cash from operations, 11.52 billion, much higher than the 97 million that we can see on average for the sector as a whole. Now, quick conclusion for this part of the analysis, we do get a triple hold right across the board, a D on valuation, an F on growth with that A+ as we saw on profitability. Now, finally, before we do get into the valuation, for those that do want to see the comparative data against others in the industry, Micron Technology, Marvell Technology, these are all in a very similar sector and pretty much very similar sizes as well. What we do want to understand here as well, is Intel performing very poorly, or is this a matter that is associated with the whole industry? Now, over the last year, including dividends reinvested as they had paid dividends over the previous quarter, they are down 48%, and we can see every single other semiconductor has posted positive returns. Over the last 5 years, when we take a look, again, very poor, the only one with negative, and again, no surprises as we've already seen, negative 26% over the last 10 years if you were to have reinvested those dividends. So maybe one of the worst investments you would have made if this was one you have been invested for at least 10 years. And again, we can see every other company performing much, much better. Now, do take this with a pinch of salt. This is just part of the analysis. As always, their past performance, which has been absolutely shocking, doesn't mean in the future it will be bad. It could be better. In fact, it could be a lot worse. Now, let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value of $28, how we got to this was through the DCF model. So we will take a look at that. And as we can see, we have the free cash flow year on year. Over the period, it has been pretty much negative, although we can see it being skewed by the massive drops just over the last few years. Now, forward looking, we've wanted to be very conservative. We've gone for 0% growth, so actually no growth at all. And we have gone for the 2024 position at pretty much the lowest free cash flow they've had over the last 10 years. Again, you could argue very conservative. With the discount rate, we then get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by their shares outstanding, and as we can see, our undervaluation signal at $28 versus the market price of $20. Now, as always, some of these numbers are subjective, so you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Intel or any other. Now, our intrinsic value of $28, when we do run it through the margin of safety calculation, we always start off with 10%. Now, for those that are new, we execute on 10% if it meets the 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, if it hits that for Intel today, a buy at $25, and then we keep going till it's near the current trading price. And in today's episode, we ultimately see if you are adding to Intel right now, you are getting a 30% margin of safety. In terms of Wall Street, they have a price target of $26, which ultimately means from a year now, that is upside of 33%. Do bear in mind that there are a lot of challenges that this company faces, but there are some good news that we are starting to see in terms of the contracts won. But it will really depend what type of investor you are in today's episode. If you're a dividend investor, maybe this one might not be for you, given they did recently cut the dividend. Again, if you are someone who's a value investor, maybe likes to buy companies when they are about to turn around or when the market has overreacted, again, maybe this might be one to consider. As always though, do give us your thoughts in the comments below. Don't forget to sign up to the free weekly newsletter below and come and join us in the Patreon where we do discuss our weekly buys and sells. As always, have a great day and we'll see you all on the next one.